What if I told you that the early signs of the next global financial crisis are already here? Back in January 2008, the collapse of thousands of subprime mortgages in the United States sparked a global earthquake that wiped out over $60 trillion in wealth, triggered a wave of bank failures, and unleashed 8 years of painful and uneven recovery. After a wave of bankruptcies, massive job losses, and a deep crisis of confidence, many believed we would never face such a scenario again. But as we enter 2025, the same red flags are flashing once again: skyrocketing debt, inflated asset prices, and high-risk lending practices. Subscribe to Global Finance 360, turn on the bell, and join us as we break it all down in simple terms, using the most up-to-date data, and explore how you can protect your wealth before it's too late. First, household debt is once again out of control. In countries like the United States, the United Kingdom, Spain, Australia, and even Sweden, household debt has surpassed 110% of GDP. This includes mortgages, car loans, student loans, and personal credit. A large number of those mortgages were signed under variable or ultra-low initial interest rates. In fact, around 25% of U.S. mortgages issued in 2024 are adjustable rate, leaving borrowers exposed to sudden hikes of 2 to 3 percentage points in just 1 year. At the same time, consumer credit is growing at 8% annually in Europe, its fastest pace since 2007, and financing for cars, education, and credit card purchases is soaring. In cities like Sydney or Vancouver, families are now spending over 40% of their income just to service their debts, compared to just 20% 2 decades ago. If inflation remains high and central banks continue raising interest rates, millions of households could face unaffordable monthly payments and risk falling behind on their loans. That same pressure is spilling into real estate markets. In cities like Berlin and Madrid, the average home now costs more than 8 times the median household income, when historically that ratio stayed between 4 and 5. Once again, banks are offering mortgages with interest-only periods or ultra-low initial payments, measures that help buyers qualify, but dramatically increase the total cost of the loan over time. Meanwhile, major funds from Singapore, Saudi Arabia, and the US are buying entire residential blocks in New York, London, and Sydney, not for local residents, but for speculation. This artificially inflates prices without expanding the actual housing supply. In Toronto, for example, condo prices jumped 15% in 2024, while rents rose only 3%, suggesting that speculation is pulling units out of the rental market and setting the stage for a sharp correction when investors need to cash out. The corporate world is no safer. Years of cheap credit have created a dangerous legacy. Global non-financial corporate debt now exceeds $85 trillion, more than 90% of global GDP. Nearly 45% of that debt is rated just one notch above junk status. This means a simple loss of confidence or a wave of credit downgrades could trigger forced sell-offs and sudden market crashes. According to the IMF, about 12% of companies in the US and Europe are now zombies, firms that only generate enough cash flow to cover their interest payments and rely on constant refinancing to stay alive. Take, for instance, a real retail chain that refinanced its debt at 1.5% interest in 2021. If its rate jumped to 5% under current market conditions, its financial burden would triple, putting its entire operation at risk of collapse. One of the most reliable warning signs in financial history is now flashing red: the inverted yield curve. This happens when short-term bond yields exceed long-term yields, signaling investor fears about the near future. Right now, the gap between the 2-year and 10-year U.S. Treasury bond has been inverted for 7 straight months, the longest stretch since 2007. Similar patterns are emerging across the Eurozone and Japan. Historically, nearly 80% of recessions since the late 20th century have followed a sustained yield curve inversion within 12 to 18 months. To make matters worse, recent events like the 2019 repo market freeze and the 2021 collapse of several money market funds show how quickly credit can vanish when panic sets in or investors demand higher collateral. After the pandemic, central banks made a radical shift. They expanded their balance sheets to historic levels and slashed interest rates close to zero to avoid a global economic collapse. But in the last 2 years, they've raised rates by more than 300 basis points, a pace of tightening not seen since the 1990s. Even so, inflation remains stubborn, around 3% in the US and nearly 4% in the Eurozone. In countries like the UK, Spain, or Italy, energy and food prices are still growing at double-digit rates. With over $15 trillion in assets on their books, including government bonds, mortgage-backed securities, and corporate debt, central banks now have limited room to buy more assets in case of an emergency. If they raise rates too aggressively, they could choke off credit, something that's already caused some small businesses and consumers to stop refinancing their loans, leading to rising defaults. On the other hand, If they delay rate hikes, inflation lingers and erodes public trust in financial stability. Meanwhile, the rise of a shadow banking system is adding new risks. Hedge funds, money market funds, securitization vehicles, and crypto lending platforms operate largely outside of traditional regulatory frameworks. In 2022, the collapse of one major crypto platform led to over $200 billion in losses and spilled into conventional investment funds. Many of these players now operate with leverage ratios as high as 20-to-1, meaning even minor price moves can trigger massive margin calls and spark a chain reaction across global markets. Because these systems are opaque, regulators often can't see the danger until it's too late. To these 6 warning signs: household debt, housing bubbles, corporate leverage, the inverted yield curve, extreme monetary policy, and shadow finance, we must add several external factors that could light the fuse. Geopolitical tensions are not only pushing oil and gas prices higher, as seen in the Ukraine war and conflicts in the Middle East, but also driving up the costs of key metals and grains. Trade sanctions between the US and China are disrupting the production of semiconductors and solar panels, forcing companies to raise prices or relocate supply chains. At the same time, global public debt is approaching 120% of world GDP, and interest payments alone now consume over 30% of national budgets in countries like Spain, Italy, or Brazil. With that kind of burden, there's little fiscal room left for vital spending on healthcare, education, or the green and digital infrastructure the future demands. Fiscal policy itself is cracking under pressure. After 2008, governments promised major reforms in taxes and spending. But today, most rely on temporary patches, one-time stimulus checks, short-term tax breaks, or year-long credits. Without long-term structural plans for research, transport, or renewable energy, productivity stalls, and any necessary adjustment, whether through higher taxes or spending cuts, hits consumers and investors harder. So, how can you protect your money and spot opportunities in this volatile landscape? Before we go any further, an important clarification. Everything in this video is meant for informational and educational purposes only. It is not financial advice or a personalized recommendation. Every financial situation is unique, and it's always best to consult a certified professional before making major decisions. With that in mind, here are 5 key principles that can help you stay prepared and protect your wealth today. First, diversify. Don't put all your savings in one country or asset class. Mix short-term government bonds from stable economies with stocks from defensive sectors like healthcare, food, or utilities, and keep a portion in safe haven assets such as gold or strong currencies. Second, maintain liquidity. Always keep at least 10% of your portfolio in cash or near-cash instruments so you're ready to buy when markets drop. Third, shorten your bond durations. Avoid long-dated bonds that lose value when interest rates keep rising. Fourth, favor companies with low debt, steady cash flow, and strong competitive advantages, like patented technologies, trusted brands, or robust distribution networks. And fifth, prepare your cycle strategy. When the next recession hits, central banks will likely slash rates again to stimulate the economy. Those with cash on hand will be able to buy high-quality assets at 20% to 30% discounts during the rebound. The story of 2008 is still a textbook. Spot the signals, act before the music stops, and build a solid strategy. If you found this analysis helpful, subscribe to Global Finance 360, hit the bell, and share this video so more people can prepare. Tell us in the comments, what's the first move you'll make to weather the next financial storm? See you in the next breakdown.